Brokers Digest, a webcast series by The Edge Singapore, discovering market opportunities with you. This episode is sponsored by Phillip Futures.
Hello and welcome back to another episode of The Edge Singapore's Brokers Digest with me, Amala Balakrishna. It's been 2 weeks since our last episode, and there's been quite a turnaround in the US market. A key announcement was the 0.3% month-on-month uptick in the consumer price levels or CPI in August. This is consistent with the 0.3% increase seen in July. However, the rise came less than the 0.4% uptick penciled by Bloomberg economists. This comes as prices paid by US consumers in August snapped a string of hefty gains, suggesting that some of the upward pressure on inflation is beginning to wane. The price data precedes an upcoming Federal Open Market Committee meeting where officials will debate how and when to begin tapering asset purchases. Chair Jerome Powell previously said that the central bank could begin reducing its monthly bond purchases this year, but didn't give a specific timeframe. Stocks fell the most in a month. The tech-heavy Nasdaq was down by 1.2% on September 17th. The 30-stock Dow Jones shed 0.5%, while the S&P 500 edged down by 0.9%. Looking at these numbers, Bloomberg Intelligence head of equity strategy Gina Adams said, September is starting off in typical fashion, with stocks struggling to maintain optimism in the face of a likely pending shift in Fed policy, slower growth, and uncomfortably high inflation. Joining me today to break down these movements is Maurice Chew, an analyst with Phillip Futures. Hi, Maurice. Happy to have you with us today.
Hi, it's me again. I'm back.
So, Maurice, like Gina Adams, do you think that optimism levels in the stock market is down?
Well, what she was referring to probably was how the stock market and risk-on assets tend to do badly for September, right? So I think there's an end of uncertainty, certainly. So headlines these days are telling people to be cautious and to be worried, but there's so many things happening at the same time. They're told to worry about what's happening in Afghanistan, what's happening in China, what's happening in Southeast Asia with regards to Delta. So name of the game is actually caution, but cautious of what I think is very hard to keep track of. One thing I'm keeping track of is actually how margin debt in the USA has been actually dropping. And that means that people are taking on less debt to buy stocks from their local brokers. And that can't be a good development for stocks in general.
So, Maurice, that's an interesting observation. So I just want to turn our attention to inflation. A survey by the Federal Reserve Bank of New York indicates that consumers are expecting inflation to rise by 4% over the next 3 years, possibly due to a rise in input costs. So what do you think this means for consumers?
Well, I think from the last time we spoke, there's been one more data release on inflation. So prices have continued moderating downwards in general, and that includes your personal consumption expenditure, which is actually what the Federal Reserve tracks more closely, as opposed to other metrics, which tends to skew the data quite a bit. So some of the data points you're seeing is that actually your producer prices are actually tracking upwards away from the rest of the pack. That I wouldn't place too much credence on it. A producer consumer price gaps, you can see them in China as well. What that does mean actually, interestingly, is that corporate profits are likely to take a hit. So if your producer prices rise, but the prices don't pass on to consumers, then obviously your margins will take a hit. More significantly, however, I think CPI seems to be trending back downwards. I'm not saying I know which direction it's going to go. I think a bit of the optimism recently over inflation peaking is a bit overdone because in the short term, there's still many unresolved supply chain issues. There's a lot of exogenous shocks, as economists would like to say, that would make it a bit too uncertain that, the worst of the inflation spikes are over. But I think the nature of inflation readings makes it a trailing indicator. So I would say take these readings with a pinch of salt, have a longer term view, and perhaps we can draw some lessons from history. So like past inflation spikes, how has that actually turned out for the US economy? Yeah, I think those would be pretty useful.
So what does history tell us, Maurice? Maybe could you tell us a bit more about that?
I would say that, referencing this slide here, where I'm looking at, say, inflation over the 50-year period, right? So one observation you can make is that, so there's the 2% inflation rate targeting line that the Fed usually uses. The Fed has actually become very good at bringing down inflation spikes since the '08 crisis. So the key difference here is that actually it's the '08 crisis. And you can see that they've had some, not say deflationary, but they've gone some way all the way back down to 0% inflation growth. And that's also not very desirable because people will start talking about deflation. And the thing about inflation, deflation really, is not really some kind of phenomenon where it's about, say, manufacturing. Is very clear cut. You manufacture, you get a price for it, that's your data point. Inflation, deflation is actually also a measure of people's psychology. So if let's say people start seeing the line trending downwards towards 0%, they start thinking that deflation is on the horizon, what they're going to do is they're going to cut back on their spending activity, their investing activity, and you don't want that as a central bank. So in terms of, say, whether deflation is actually going to happen anytime soon, I think that is quite a difficult question to answer. I think the probability is actually quite low. One thing interesting to me is actually that people are actually, when they look at the features of the US economy, so to speak, before COVID-19 hit, there were a lot of signs of the US economy, very broadly speaking, actually mirroring Japan's sort of liquidity trap situation in the 90s. So there was a bit of worry about that before COVID-19 hit. And I think, the Fed kind of got their lucky break when COVID-19 came around, and that discussion just got sidelined for a while. So there's that discussion. In short, deflation, I don't think is that possible yet. If I were to summarize what I just said, however, there's one camp that says that deflation is going to come when they look at the last 10 years track record, and another camp that says that it's going to be hyperinflation, and you're going to see volatility in the market in the near term, really, and there's not going to be a clear direction because people are just tussling over which is it. Is it going to be deflation, inflation? Yeah.
Actually, Maurice, two things stood out for me from what you just said. The first is on the psychology of consumers, and it reminds me of how like the older generation talks about the increase in the price of, say, Hokkien mee from around 5 cents last time to $5 now. I think the price is quite debatable, but yes. So another thing is that market watchers have also raised concerns that the Fed may raise inflation through increases in money supply. But economics does tell us that that may eventually result in a liquidity trap, something that you just touched on a bit. So maybe you could tell us a bit more about this, and when do you think it's likely to happen, if that's possible?
Right. So diving a bit into the data, these are very simple data points, so to speak, right? Research done before the '08 crisis showed that, in general, when your money supply increases, inflation increases as well. The relationship was generally established to be every 1% increase in money supply is about 0.5% increase in inflation. So if I were to break that down, if let's say you were to pay for your Hokkien mee at about like you said, maybe $3, $4, $5, let's say $5 in 2008, by this pre-GFC measure of how inflation is supposed to interact with money printing, my word, would be right now today you'll be paying $25 for a plate of Hokkien mee. That's the fair price of it based on the relationship between money supply and inflation. So in a way, you can term this as missing inflation. Where has the inflation gone? It's either, you can think of it one of two ways. It's either the something else is at work that isn't really understood by the mainstream yet, or you're talking about very huge deflationary force pulling back inflationary forces throughout this 10-year period. So inflation has been quite stubborn to grow. So I think in general, for the more veteran funds especially, right, recent Bank of America survey, they kind of they seem to, the responses actually, when aggregated, seems to suggest that people don't have any doubt that the Federal Reserve can bring down inflation, be it 2022, 2023, consensus seems to be about 2023. They don't doubt that, but what they doubt is the ability of the Federal Reserve to bring inflation back up, because they're already at zero rates. So how much lower can they go? They're not going to talk about negative rates. So likelihood-wise, I think it's still up in the air a bit, but definitely we are, it's balancing more towards the inflation is largely over. the inflation spike is largely over for now. Yeah.
I'm actually curious, like, regardless of whether or where we are in this inflation cycle, I'm curious as to how an increase or decrease in consumer prices may actually affect our retail investors, like our viewers, in terms of how they should be making their investment decisions. Like, would you say that there are specific sectors that they should be looking at, or should they be adopting value investing over growth investing? Yeah.
I think the inflationary perspective, so let's say inflation, deflation, right? So the inflationary perspective has been talked about quite a lot. So for example, when there's inflation, your future earnings get eroded. That's the basic narrative. Therefore, for growth stocks, because most of your valuation right now, your price is baking in your future earnings, right? So therefore, your fair value for growth stock kind of goes down. So that's the basic kind of theory for inflation and growth stocks. One thing I would actually highlight, apart from growth stocks, right, perhaps never mentioned on this show with you guys before, is actually, I think there's a relationship between inflation and small caps. Small cap stocks tend to do pretty well during inflationary periods, but not because of inflation, but because these inflationary periods tend to coincide with, at least in my view, it tends to coincide with periods of overheating economy. So it's like you're seeing a lot of demand, consumer consumption demand from the economy, and that tends to be a pretty good catalyst for small caps to do well. So if the upcoming kind of impetus for inflation is really because, hey, we need to taper back our easy monetary policy, we need to increase interest rates because the economy is expanding too fast, then that's generally a climate that small caps do quite well. If I were to talk about deflation, on deflationary forces, I think investors should be more careful of companies with a lot of debt. And there's a few aspects to be wary of here. So firstly, when you're talking about deflation, what is deflation? Deflation, because let's break it down to the average consumer's choice. A dollar you have now will be more valuable in the future than now. So you have an increased incentive to hold on to it and not spend. But what is the economy all about? It's all about spending money you have or don't have. Depends on who you ask, credit, right? So if people spend less and the economic growth kind of crimps and you still have debt that is also growing at the same time because of deflation, what you're seeing is that especially companies that their projections for debt repayment has a lot to do with aggressive market expansion. For example, I capture the market share, I sell more of my goods, I project high double digit kind of revenue expansion. But because it's a deflationary spiral, you're going to see consumption decrease. Are you going to hit those targets? It's going to be a bit more difficult at the very least. And while that is at the same time becoming more difficult, your debt load is going to increase because it's deflationary at the same time. So, what is the fair value for a stock like that? Our wager is actually not as high as it is now, especially when deflation comes into the picture. So that's one aspect of it. The other aspect of what to look at, perhaps more for more cautious-minded people, will be, during a deflationary sort of period, right? What do people usually not have to cut back on? Things like utilities, staples, your telecoms, things like that. So these are things that people are less price sensitive to. They need to spend on those items anyway. Sure, they're not going to spend even more. So let's say if your local utilities company comes up with some special way of I don't know, flavored water instead of normal water, or water that's better for your plants, you're not going to see people rush to that and you're going to capture more market share or anything like that. But in terms of protecting what you have, protecting your current valuation, I think those companies would probably do better during that period.
I think that's quite a good insight, Maurice. Like, because take cue from what's happening in the economy and what sectors are being marketed. I think that will be a helpful way to decide on which sectors or that you can possibly put your money in. So maybe before we end today's discussion, we must talk about the elephant in the room, right? Evergrande. So analysts warn that the potential fallout could have far-reaching implications that will spill outside of China's borders. So one economist has even said that the Chinese developers' collapse would be the biggest test that China's financial system has faced in years, especially since banks like HSBC and Standard Chartered have declined to extend loans to buyers of the two uncompleted Evergrande residential properties. So against this backdrop, Maurice, what advice do you have for our viewers? Are there any opportunities for them to capture, if at all?
Right. I think some features of the Evergrande, what's happening over there needs to be recognized universally first, which is, if you are a citizen or if you are residing in China, how to say, their access to investment is a bit more restricted. Let's put it that way, a bit more restricted than say others, right? So what do I mean? Let's say, people will be familiar with what happened with, say, Forest City in JB when they started to implement capital controls. So what I'm saying is, what the Chinese person can, in general, theoretically, invest in is actually quite limited. And a lot of Chinese people actually choose to invest in properties because of that, right? So you're seeing actually a lot of debt load being taken on by the average person, by companies actually, to both purchase properties and also to fund more property expansion. So the term eludes me currently, but it's akin to house flipping, where before the property's useful lifespan is up, they are very fond of knocking it down, building something else on it, and then selling it for even higher, which is fine. But the thing is, a lot of them took on too much debt while doing it at the same time. So what you're seeing now is, as of this week, right, Evergrande will start selling off properties at a discount to pay off their debts. So there's a lot of debt restructuring plans. Take a pick. It's quite interesting to read through all of them actually. But the thing is, how are property prices determined? The valuation for your house, right, unless you get a professional valuer to come in all the time, actually it has a lot to do with the value of the houses being sold in your neighborhood, right? So if Evergrande is selling all these things at a super discount, then your own valuation goes down. But the thing is, you have your own debts to pay because you took on debt to buy these houses. So are you willing to let your own valuation go down? Probably not. So what is your decision matrix so-called now? Hold on to your property, perhaps watch the value go down, and perhaps have some difficulty paying off in the future, or sell now. And the more you sell now, because now you're going to see the supply go up, right? And then are there that many buyers out there in this kind of climate? I don't know. So this is extreme bearish case. And so all of a sudden you sell it, and then everyone in your neighborhood also sees the price go down. So what are their decisions going to be like? So that's the extreme bearish case, and it has a lot of implications on property market, on corporate debt, on maybe even the financial sector. That's a bit of beyond my domain already in China. So that's why when people say that it's going to expand beyond Evergrande, I suppose that's what they are referring to. As for when it comes to a lot of entities out there, especially if I may name one in the cryptocurrency space, it is unknown whether they are actually holding on to Chinese corporate debt. And if those companies go under, then of course the holdings of those kind of entities also will be underwater. So that is the major kind of worry when it comes to what's happening with Evergrande there. It takes definitely more than just a 3-minute response to actually cover it fully. And I think the best minds in the finance are now wrangling with this issue. But definitely, if Evergrande hasn't been on your radar yet, and you have some position in equities or some other risk-on assets around the world, I think it's worth your attention to read more into Evergrande currently.
I think time will tell us as to how this whole issue will pan out. So with that, we have come to the end of this week's Brokers Digest. Thank you again, Maurice, for sharing your insights and tips with us. So to our viewers, we hope these strategies help you in your investment decisions in the short and medium term. For more analysis on the stock market, you can visit the websites of Phillip Futures or The Edge Singapore. Do like us on Facebook and Instagram to be alerted on our next episode. We'll be having an insightful session on ETFs that you won't want to miss. You can also leave us a comment below if there are any questions or topics you would like for us to discuss. Once again, I'm Amala Balakrishna, and with me is Maurice Chiu, and we'll see you again in 2 weeks. Goodbye.